Welcome back. As flat can be on the indices, but we'll take the conversation forward. Ashutosh Bhargava, Fund Manager and Head of Equity Research at Nippon India Mutual Fund, is with us. Ashutosh, good morning, and thank you very much for being with us on the show. So we're all trying to sort of look for direction. I think the market's trying to make sense of things, and earnings are the real litmus test, right? We were looking at some of your earlier holdings. This is, of course, as of 2-3 months ago. Tell us if this has changed. But you seem to have a lot of large cap financials, particularly large cap banks in your portfolio. There's Axis, there's HDFC, there's ICICI. And if ICICI's numbers are anything to go by, this seems to be at least one pocket of the market that's rock steady and firing away. Your thoughts on financials, whether you've done any changes to your holdings, valuations, and whether you can still put more incremental money, fresh money to work in the same stocks?
Thanks, Ruby. So yes, financials, we have been overweight, particularly on large banks. The reason is twofold. One is the valuations. I think valuation, despite the run-up in banking index, they remain cheaper versus their stocks' own history. They particularly remain cheaper versus the rest of the market and other large sectors like IT, etc. We have seen a massive amount of upgrades in FY24, throughout FY24, in banks earning. And we think at this point of time, the credit quality, whatever estimates we have on credit growth, and more importantly, the elevated margins that we are seeing, makes us believe that the 13-14% earnings growth, which is expected over the next 2 years, that estimates will easily be met from financial side. So both from the valuation perspective and more so from the earning resilience perspective, we think this is one sector which could continue to take market relatively higher.
Follow up, Ashutosh, on that. You mentioned margins. A part of the market, at least a section of the street, feels that we've seen the best in terms of margins, and now it only comes down from here. Could that lead to some profit taking? Is that a concern you have?
So there's no doubt that margin re-rating has been very sharp, but we don't think that margins are going to come down materially. Yes, we might be near the peak margin, which some of the banks have also highlighted. But we think there are some levers which can keep margin at these elevated levels. And within banks, I think from the public sector bank side, there is still potential for margins to further go up because there is a significant section of assets which are still fixed cost in nature, and there is a potential for upward repricing of those assets in next 1 to 2 quarters. So there you could even see margin expansion. For the large private bank side, yes, you could be right that we are very near to the margin peak. But as I said, the hurdle rate is very low from banks' profitability expectations are concerned. 13-14% expectation for the next 2 years. I think that can easily be met.
Ashutosh, morning, Rima here. As a house, what is the call on investing in large caps, mid caps, or small caps? Because small caps have gone through a very long period of underperformance. I think in the last 5 years, the return has been negligible, practically flat. The markets at the same level as what they were in January of 2018, thereabout. So given the kind of underperformance, the time correction that we've seen, and the fact that valuations are also fairly reasonable in small caps, would you recommend a higher allocation in your SIPs to small caps versus the large caps? What's the house call here?
As a house, we believe that there are opportunity in all the 3 size category, large cap, mid cap, and small cap, and we are not particularly tilting over one over the other. What we think, the better approach would be to look at sectors where this year there could be some bit of top-line recovery, because that won't be there in a lot of sectors. But there is a reasonable amount of margin recovery, which I think could be there in a lot of sectors in FY24. And try to find bottom-up ideas across 3 market sizes. Purely from valuation perspective, when we look at small and mid-cap valuation discount to large cap, that doesn't give us a lot of comfort to squarely and overly go overweight on mid and small cap over large cap. But the point is well taken that over the last 18 odd months, the broader market or the side market, there the overall time correction and valuation correction has been more pronounced. But it's very difficult to be overweight on one over the other.
Okay, so you're not really recommending a move away from large caps to small and mid caps. And you did say that you will have to look at specific sectors to find opportunities, or even specific stocks. You want to take us through some sectors. I know you like the financials, like you mentioned, but anything else where you think overall that sector is likely to do well, even in a very range bound kind of market?
That both local and global nominal growth would be under pressure over the next few quarters. What will drive earnings and perhaps the stock returns would be margin. And I think there are sectors where you could see a meaningful margin recovery, along with some bit of top-line support. Sectors like autos, pharma, utilities. So other than financial, these are the sectors where there is a potential for us to increase weights and be more constructive. Staples is another sector where we could see some margin upgrades and marginal, growth in terms of top line. But as I said, some of these domestic-oriented sectors like domestic autos, utilities, banks, these are the ones we have maximum confidence as far as earning resilience is concerned.
And you mentioned that you could look at increasing weights in auto and also auto ancillary, or are you looking at only autos for now?
So domestic-oriented companies is where we think there is more demand resilience, and domestic OEMs across the board is where we think there could be, upgrade possibility, or earnings would be much better than the rest of the market. So this is where we would focus more on rather than, ancillaries, where we already have exposure and they have some exposure in terms of global growth, which to our mind could be in the near term would be a challenge.
So by that logic, would you lower your weightage or downgrade technology?
So the thing with tech is that, if you just compare with, say, financial, there the valuation premium at which tech was trading, it has narrowed, but still remain at a premium versus the long-term history. So typically, IT index has traded on a one-year forward basis around 8 to 10% valuation premium, say, versus bank index. Today is still around 15% higher valuation premium. So we think that purely from valuation perspective, IT is not that attractive. And when we think from short to medium term earning potential, earning upgrade potential, I think banks are stand out, and we perhaps could see 1 or 2 more quarters of IT earnings to bottom out. So in that sense, we have remained underweight on IT versus financial, and I think that stance would continue for another 1 to 2 quarters. And then we reassess at that point of time for potential risk reward in the subsequent quarters.
All right, so not yet for IT names. Ashutosh, thanks as always for joining us and taking us through your call. That is Ashutosh Bhargava telling us that the sectors he still likes are the financials, some of the autos, and also stable names within the Indian market. But with that, it is time for a short break on the show. When we come back, we are going to talk about how the incremental business momentum has looked like in FY23 for the banking sector. It has been the best ever. We're going to bring you all of the details when we come back.